We'll come on to the outcomes in a bit. What we are doing since 2008 is mutualizing the bankruptcy of the system via the debasement of currency, which is the
When you say mutualizing, you mean making it everybody's problem?
Yes. So economic activity is what pays the interest. If you don't have a job, you can't service your mortgage or your credit card, right? Fact. And if your debt growth keeps going up, you need to keep your wages going up to pay your debts. That's the GDP side of the equation.
Globalization is often cited as a key factor in widening the wealth gap through labor arbitrage, where companies outsource manufacturing jobs to countries with cheaper labor. This reduces production costs and boosts profits for asset owners and shareholders. While these groups thrived, the middle class, previously employed in these factories, faced job losses and stagnant wages. Raoul Pal, in an interview with Tom Bilyeu, discusses how debt cycles and the financial instability they create play a significant role in this widening gap, particularly after the 2008 financial crisis. The crisis exposed the fragility of the global financial system, with both individuals and governments increasingly relying on debt to offset stagnant real wages. This economic shift has fueled social issues like the opioid epidemic, as people struggling with financial hardship and despair turn to drugs. Pal stresses that addressing this growing economic disparity and the resulting social problems is crucial before we can focus on broader systemic reforms.
Stop. You don't have time. Don't miss out this 2025 bull run. Educate yourself first ahead of the crowd. We have created the ultimate step-by-step crypto cheat guide that will guide you this bull run. Unlock the secrets of crypto and make smarter investments today. Now by clicking on the link below to get your exclusive copy just under $10.
We'll come on to the outcomes in a bit. What we are doing since 2008 is mutualizing the bankruptcy of the system via the debasement of currency, which is the...
When you say mutualizing, you mean making it everybody's problem?
Yes. You can either raise taxes, which they're trying to do too, but they're also printing currency via the mechanism called quantitative easing, which is actually debasing the currency, which means that every time they do it, asset prices optically rise. They don't actually rise, because if you look at the central bank balance sheet and divide all assets by it, so you're changing the denominator. It's normally US dollars, but when you use the balance sheet, you say, okay, this is the purchasing power of dollars. Now, how many dollars are in the economy or excess printed? And what you find is something like the S&P 500 has gone nowhere. Real estate, gold, gone nowhere. And there's only two assets that have actually outperformed, which were crypto and technology. After the Fed started monetizing or lowering the value of the denominator, the economy grows at 2%. The government needs that to pay its interest because it's 2%.
How does it use that to pay its interest?
Well, basically it comes...
Because they're just taking more in taxes?
Exactly, right? There's a level of economic growth that needs to service the interest payments. But if everybody's interest payments are too high, the answer is firstly to have the interest rate as low as possible, which is why the Japanese have a much lower natural rate of interest than everybody else, because they're 260% of GDP in debt. But their companies are less in debt.
So they've trapped themselves. They have so much debt, they can't let the interest rate rise.
Nobody can. This is why we're going to have a recession and we're going to cut rates back down to zero. It's impossible to work. So this is the thing, is once all of these governments hit 100%, then you either blow up the private sector, the banking sector, corporates, or the government sector. You choose.
How?
Because there's not enough income to service that level of debt, because GDP growth keeps declining. So economic activity is what pays the interest. If you don't have a job, you can't service your mortgage or your credit card, right? Fact. And if your debt growth keeps going up, you need to keep your wages going up to pay your debts. That's the GDP side of the equation. But what we're finding is that all debt that is in excess of GDP at government level is ending up on the balance sheet 3.5 years later. And I did the maths on this, and I think I was the first person to really figure... I don't think anybody's really figured this out yet. I went and looked at this, and I realized that what they were monetizing was the interest payments on the debt 3.5 years later. Okay, why 3.5 years? In 2008, all interest rates went to zero. Every government refinanced itself at zero. And most of the debt for all governments is in the 3 to 5 year sector. So somewhere between 3 to 5 years, 3.5, 4 years. And what happens is every time you service the debt, you need to get the interest rates back down again. You end up having a recession. You get this very cyclical phenomena.
Because are they deferring the need to pay for 3 to 5 years?
Nobody pays back debt. Nobody. Nobody is paying back any debt anywhere. So what they're doing is every time it comes to pay to service the next amount of debt, it ends up on the Fed balance sheet. Now, it actually happens because there's an economic slowdown driven by the debt, but that's what happens. And there is a marginal difference in the size. This is true of the US, the UK, the EU, Japan. They're all the same. And the difference of the balance sheets is slightly bigger. And the difference is every time there's a direct financial crisis, they have to put direct money in. So we've already just seen a little bit of that in the US.
Raoul Pal argues that since the 2008 financial crisis, the global economic system has been effectively distributing the burden of insolvency through mutualized bankruptcy and currency debasement. He believes governments employ two main strategies to manage this: raising taxes and printing more money through quantitative easing. This process weakens the currency, making assets like stocks and real estate appear more valuable, even though their real value hasn't increased when adjusted for inflation. This trend particularly affects younger generations, such as millennials, who entered the workforce after the Federal Reserve began these practices, making it more challenging for them to afford assets like housing and widening the wealth gap between asset owners and non-owners. Raoul explains that governments depend on economic growth to cover interest payments on their debt. Ideally, the economy should grow at about 2% annually, allowing the government to collect more in taxes to meet its interest obligations. However, as interest payments and debt levels rise, maintaining low interest rates becomes crucial. When governments reach a 100% debt-to-GDP ratio, they face risks of damaging the private sector, banking sector, or overall economic growth as it struggles to keep pace with rising debt levels. This situation is why many experts anticipate further economic difficulties. Let's return to the interview for more insights on this topic.
The thing that's actually driving the S&P 500 is the Fed balance sheet. So it's an optical illusion. It's a money illusion.
So the price simply rises to meet the level of inflation caused by printing money.
Correct. You're readjusting the price. So that is what's going on. And so then when you understand that, and it's 97%, you understand that nothing matters apart from this liquidity, which is what I've been trying to tell people, is sorry, all your economic models are wrong. Yes, you need to forecast the business cycle to know where you are in the probability of printing money cycle, but that's all that matters, and it drives assets. And that's why people right now are getting very angry because the stock market's going up, and they're like, yeah, but don't you know there's a recession? Yeah, I know that the answer to a recession is more cowbell, printing of more money. I know what drives liquidity. It's driven by the business cycle, and there are certain cycles that are forward-looking. The Chinese credit cycle happens to lead by about 18 months or 2 years. The business cycle is the ebb and flow in economic activity that occurs, and that's a boom and bust, a recession expansion. And one of the things we do is when the business cycle is too hot and inflation starts rising, central banks tend to raise interest rates. That tends to bring down economic activity. I think even without a central bank, interest rates would rise naturally, because I think the free market can set interest rates without a central bank. And then the economy slows down again, and we see this endless cycle. So we're looking at more than a doubling of the NASDAQ from here. We're looking at another gigantic crypto run. That's into 2025. So we're seeing huge moves that just come from the debasement. And I've gone through in the Everything Code article that I wrote for Global Macro Investor, which is my kind of premium research service. In that, I've gone through various ways of proving this all out. So that's what I think I can do. But your observation, I think, is really important. When people, I mean, I've sent this to quite a few people, and obviously the subscribers of Global Macro Investor are kind of the world's most famous hedge fund managers, asset managers. And I think it really shocked people and resonated with people. They're like, oh my God, everything makes sense now. And so once you see it, it all makes sense. Now, as it becomes more public as a thesis, and Mike Howell at Cross Border Capital has been talking some elements of this, liquidity, you can see liquidity becoming part of the conversation on financial Twitter and stuff now. What I think we'll probably do is create boom bust cycles. Again, you can't have the bust cycle going below the level of central bank liquidity because optically they make it rise. This is what people don't yet understand. But of course, the stock market should go down 90%. Can't happen. Literally can't happen because of the debasement. It's a money illusion. But what I think we'll do is see, hey, off we go to the races. That's what happened in 2018. 19, early 20, we actually diverged from the central bank balance sheet massively, because people starting to figure out this game, which is the moment the Fed stop the tightening cycle, markets take off, because they know that the probability of more cowbell, more central bank printing of money, more interest rate cuts is coming. And so therefore we get boom bust cycles. So the boom times are too big, and then you get a bust. And people know that from crypto as well. The long-term trend remains intact, but we keep getting these huge booms, collapse, boom, collapse, but the trend is still up. I think that's what we'll see. We'll be more like the crypto cycle, which is pretty much what we've just seen as well. We had a big collapse last year, and now we're straight back into the boom as we're starting to forecast this.
In today's economic environment, understanding the impact of inflation on stock market returns is crucial for investors aiming to protect their portfolios. While moderate inflation can support economic growth, excessive inflation can destabilize financial markets and erode purchasing power. Investors need to understand how inflation affects market dynamics and develop strategies to mitigate its impact. Inflation tends to increase market volatility, especially during periods of high inflation. This volatility arises from uncertainty surrounding consumer spending, corporate profits, and overall economic conditions, often leading investors to seek safer assets. As Raoul Pal has noted, inflation can distort asset values, making it essential to analyze both real and nominal returns. Historically, high inflation has been associated with lower real stock returns, so recognizing this trend is critical for making informed decisions during inflationary periods. Central banks and government policies, including interest rate changes and fiscal measures, play a significant role in market performance. Monitoring these policy shifts is crucial, as they can either alleviate or exacerbate inflation's effects on the market. To guard against inflation, investors can use strategies such as diversification and risk management. In summary, while inflation poses challenges, it also presents opportunities for strategic investors. By understanding how inflation impacts various sectors and asset classes, investors can better navigate economic uncertainties and build portfolios for long-term success. As we conclude, what are your thoughts on the current economic climate? Do you believe inflation is a vicious, endless cycle? Share your thoughts in the comments below. For more Daily Dose Crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.